Hello, everyone. I'm Matt Clark, a research analyst with Money and Markets, here with another episode of Investing with Charles. Now, what we like to do here is we like to bring on Greens on Fortune's co-editor Charles Sizemore in wherever he may be around the world, whether he's running from the law or evading something. I don't want to start any rumors, but wherever he might be, we track him down, we get him on camera, and we talk about the questions around the economy and finance that you want to know, because he's got kind of a rare pedigree, and that is, he does have a degree in finance from the London School of Economics, which is one of the most prestigious universities in the world, next to my very own Johns Hopkins. So I say next to, it's not above, it's kind of that next tier right below Johns Hopkins. But we'll get into the academic debate a little bit later. But so Charles, welcome. Still in country, in Peru, in South America, enjoying
on the farm, in fact.
Yeah, enjoying the lush landscapes of horse country in rural Peru.
I am. That is exactly what I'm doing at the moment.
Well, we're glad you could join us. Now, today, I talked about this a little bit before we got started, but I found an article of interest yesterday in the Financial Times, and it talks about the price of homes, and we've seen how home prices have moved up exponentially. They've pared back a little bit of late, and it's kind of a wonder where things are going to go. Well, what the Financial Times did yesterday is they took countries that are surveyed and covered by the OECD. Now, I'll let you explain what the OECD is, because it's the Organization of Economic
Cooperation and Development.
Cooperation and Development, yes. And
I love acronyms.
So there's an index that basically indexes the housing prices for those countries and averages them, and then they compare them against all the other countries separate individually. So it kind of, are they up, are they down, kind of where they rank. And I know that just in the first 3 to 5 months of this year, we have seen a little bit of a drop in home prices. However, what the study found was that the smallest, the house prices only fell very briefly, and it was the smallest proportion of drop in housing prices since they started tracking the data back in 2000. So in the last 21 years, while we see, housing prices are going down, they're not necessarily going down nearly as much as people might think. And then I went a step further. Before I wanted to bring you on, I want to say, okay, well, how does the U.S. compare? Now, the data goes back to basically the Q4 of 2020, Q1 of 2021. So we don't have Q2 numbers just yet. And in the U.S., the data for the 40 countries on the averaged out to about 130.9. Now, this is an index value. It's not a dollar value or anything like that. It's basically just like a stock index or something like that. It basically takes the average, equal weights them, and then spits out a number. And it's been consistently rising. But for the OECD countries, which is 40 of them, it was 130. In the U.S., in Q1, it was 152.8. So still 22 points higher in the U.S., suggesting that house prices in the U.S. are considerably higher than the average of all the other countries in the OECD. And just kind of put that, I'll give you a little perspective. In Brazil, which is near Peru, the index for
they share a border in the Amazon.
They share a border out, and you want to talk about the middle of nowhere. The Brazilian housing index was actually at 57. That is almost 100 points below the average. In Mexico, it's about 122, so right about 2 to 4 points close to it. Colombia is at 144, so about 20 points higher. Chile is right in line. They're right close together. And in Canada has actually spiked near prices like the U.S. It's about 153 compared to the index value of about 130. So what we're seeing here is that at least in the U.S. and in Canada and Colombia, for whatever reason, housing prices continue to move higher. So I guess I want to take kind of a personal finance track here instead of talking about a stock or a sector or whatever. Let's say that you are considering buying a home at this point in your life, whether you are in your 20s and you want to buy your first home, or you're in your 40s and you're looking to move, or you're retiring and you're wanting to move to another place somewhere else. Is this really a good time to buy, Charles?
Before I answer that, I will make an observation. Life on the farm right now, there is a fly that is just dead set on going up my right nostril right now. It is really a challenge to keep a straight face talking to you while I have this fly just steadfast insisting on flying up my nose.
We'll be paying close attention as you try to swat it away, without anyone noticing.
Just suavely do that. But yeah, anyway, I can explain some of the differences between the U.S. and the rest of the world with one word, and that's stability. The U.S. never really got unstable during the pandemic, whereas a lot of the rest of the world did. I can say here in Peru, property prices are down about 30%. And no matter where you go, well, I'm in farm country, this is a bad example, but if you go into the cities, you'll see for sale and for rent signs everywhere. It's bad. It is actually really bad here. Part of that's also political. People are afraid about some political changes down here, but it really comes down to stability. The U.S. has been stable throughout, and so it's been seen as a safe haven. You couple that with the fact that inventory is really low right now. The National Association of Realtors published data as of the end of June. We don't have July data yet, but it said that overall the inventory of houses for sale in the U.S. is down over 20% from this time last year. So I mean, that's a massive shrinkage in inventory, exacerbated by the fact that you really haven't had a lot of new home construction. Like the pace of new home construction wasn't really keeping up with demand before the pandemic. And then you throw in pandemic closures and you have a real shortage of stock. At the same time, demand has never been higher because people that have been renting or stuck in an apartment, they've wanted a house for a while. Now they really want a house after experiencing last year. Plus you have the millennials finally, getting married, starting families, kind of moving into that stage of the life. So it was the recipe for an explosion in home prices. Now that brings the question, should you participate in this? When you, in my neighborhood in Dallas, I'm actually looking to sell. My house is falling apart, and it's too small for my family of 5. It's time to move on. So I'm going to have no problem selling it. Of course, my dilemma is, what do I buy after? At this point, right now, you enter this, you try to buy a house, you are getting into a bidding war. Like you will be fighting for the house with other buyers. I've seen house prices go for 30, 40, 50,000 over ask. So this brings up a couple questions. One, kind of generally speaking, what is the point of home ownership? Why would you want to do that to begin with? The short answer is equity. Yeah, there's some tax benefits. Yeah, it's nice to have your own place. Yeah, it's nice to be able to kind of leave your mark on it. But at the end of the day, when you own a house, you build equity. If you have 10%, if you make a 10% down payment and the value of your house rises by 10%, well, you just doubled your money. Yeah, like that's the leveraged effect of homeownership. It's that leverage really helps you on the upside. Now, of course, swatting that fly away. That leverage can cut both ways. If home prices decline ever so slightly, your little sliver of equity can get completely eliminated. If you have only 10% down, a 10% reduction in home prices wipes out your equity. If you have 5% down, a 5% reduction in equity wipes you out. So that's something you have to be cognizant of. Do you intend to live in this house for several years, long enough to kind of ride out a cycle? If not, you probably don't want to buy right now. I would say even more fundamental than that, though, is the issue of affordability. Wow, that fly actually went up under my eyelid. I don't know if that showed up on film, but that was remarkably uncomfortable. Anyway, back to the issue at hand, affordability. My general rule of thumb is, look, if you can stretch a little bit and buy that house, and by stretch a little bit, I mean, if your budget is, just make up a number, $3,000 a month is what you would like to pay for a house, but you're going to realistically pay $3,500 or $4,000 based on current prices. But you can make a few changes to your lifestyle, and you can reasonably expect that in a year or two, you'll be, your income will rise, you have income stability, et cetera, et cetera. It's probably okay to stretch a little and buy a little bit more house than you think you can afford. But when I say a little, I mean a little. Like, don't stretch too far, because do you want to live in a house bad enough to forego vacations, to forego restaurant meals, to basically, not be able to afford anything fun in your life in order to make that home payment. You don't want to be in that situation. And you can also, if we're looking at bidding wars, do you really think you're going to make a good decision if you're having to rush to make a decision because there's 15 people behind you all throwing money at the same house? That puts you in a position where you're likely to make a mistake. You're likely to buy a house without really giving it proper consideration, without really looking at it, without really looking at the numbers, because you have this pressure to just go quickly and do it. That's a mistake. Yeah, I would say if that's the market you're in right now, don't play that game. Rent for the next year, rent for the next 6 months, whatever. Just rent for a while and re-enter this market 6 months to a year from now. See what it looks like then. It's still going to be tight. And unless something fundamentally changes, this housing market is going to be tight for a while. You don't, Rome wasn't built in a day. You can't snap your finger and make housing inventory just fall out of the sky. It doesn't work like that. But I would say you are at least more likely to get a more normal supply demand balance. It's still going to be tilted towards the sellers, of course, 6 months to a year from now, but it's maybe not as much. So I would say, look, you don't want to play this game. Back off for a while, reevaluate.
The other thing that we can't, I'd be remiss if we didn't mention is that mortgage rates are very, very low. And I'm just looking at a chart here, and in 2007, mortgage rates in the U.S. and Korea and Canada were upwards of 6%. Now those rates are hovering around 2%. To put it to put a little bit finer point on it, in 2007, the interest rate in New Zealand, for whatever applicable reason that is, was 10%. That was the mortgage rate in New Zealand. So yeah, you were getting 10%. You were paying 10% APR on your home loan. Now, today, it is 4%. That is a 6% drop in a period of 13 years. That is massive. And the thing is that, for me, in terms of interest rates, because if you look at the other countries here, their drops over that same time period are not nearly as profound. It's not an upward slope or a straight downward slope. It's more of a kind of a slight drop. So to suggest that now is the best time to get into, preferential mortgage rates or things like that, bear in mind, it took a long time for these, with the exception of Australia and New Zealand, for these rates to drop the way they have. And in Japan and even in Taiwan, they haven't really dropped that much at all. So if to think that it's going to go up that fast, it's just like the stock market. Things do not move up in a straight line. And so if you're worried about
that's a really good point, actually. That is a good point. A lot of people worry about, what if I miss out on low mortgage rates? Well, okay, that is a risk. I mean, if mortgage rates were to go significantly higher, that does materially impact how much house you can afford to buy. But as you said, it doesn't go from 3% to 6% overnight. It may go from 3% to 3.5% over the course of 6 months to a year, sure, and that extra 0.5% does matter. But remember, if interest rates rise, that is going to put pressure on home prices. That will kind of keep a cap on how aggressively fast home prices can continue to rise. So I would consider that to be. It's a risk, sure, but I would consider it to be sort of a wash.
It's more of a balance.
It's more of a balance.
So when you see home prices go up, interest rates
I just
go down.
ate a fly, by the way. If you're wondering what's going on, I literally just ate a fly. That.
And I'm just happy we caught it all on camera.
Gotta love farm life.
So houses and flies. That is our weekly episode of Investing with Charles. Is do I buy a house? How do I properly swallow a fly?
Well, the bigger picture here, what you're missing is the investment opportunity. Selling anti-fly, pesticides or misters or whatever in rural Peru, that is the business of the future.
You're missing a market opportunity, I think. But so the bottom line here is that now it's okay to buy if now is your time. Do you want to pull the trigger? Now is fine. You are going to pay a little bit more because home prices are high, but your interest rates are going to be your mortgage rates are going to be relatively low. But if you're willing to sit it out and wait 6 months or wait a year, then there may be a little less squeeze on the supply, and mortgage rates aren't going to rise.
There's an old expression. There's an old expression that all politics are local. Well, you could say the same thing for real estate. All real estate markets are local. if the dynamics of your neighborhood are the neighborhood you're looking to buy in are such that supply and demand are relatively balanced, prices haven't gotten completely out of control, or even if they have, even if prices, you look at them and you think this house is not worth what they're asking, but I want to live in that neighborhood, I can afford it, it's within my budget, my kids really like it, my wife likes it, whatever. Like if you have reasons that you want to live there and it's within your budget and you're willing to accept the fact that there may be a little bit of price risk buying in at these prices, then okay, it's a personal decision. There's nothing wrong with that. It's not always about numbers. At the end of the day, this is your home. You want to live there. But I would advise against, scrambling and getting into a bidding war and feeling like you have to, that fear of missing out. Whenever you make a decision based on the fear of missing out, it's almost always a bad decision. So
that's right.
If that is the case in your market, then take a breather.
Yep. And as my wife tells me very astutely, if you don't love it, don't buy it. And that's for anything.
Yeah.
I mean, it could be a car, it could be a pair of shoes. I mean, if you don't, she'll ask me, do you love them? I'm like, yeah, not really. Well, then don't buy them. And it makes sense. And I think the same thing applies here for homes. Charles, thanks so much for taking some time out on the farm and swatting flies and telling us about all the horticulture of rural Peru. But again, I do want to remind everyone, we do have a lot of things going on YouTube, including Investing with Charles, this video series. Ask Adam Anything with Adam O'Dell, as well as our marijuana market update. And the Bull and the Bear podcast. And again, if you missed out, if you do kind of give us a question, if you have a question for Charles or myself or for Adam that you'd like us to take on, you can do so. You can email us at feedback@moneyandmarkets.com. We'll flash that email address right down there. And if you ask a question and we use it, then you're going to get reached out by our customer service team, and a hat plus maybe some other stuff could be coming your way. So email us feedback@moneyandmarkets.com, and that could be a question for Adam. It could be a question for Charles. If maybe you want to talk about the cannabis market, then you can hit me up for the marijuana market update, any of that. Plus, new YouTube membership program is up and going strong. Just click join down below on our YouTube channel, find out more about what you get and how it all works, and you'll get all that information. Charles, again, appreciate your time and enjoy sitting down and talking about the economy with you. He is Charles Sizemore. He is co-editor of Green Zone Fortunes. I am Matt Clark, research analyst for Money and Markets, and also research analyst for not only Adam O'Dell, but for Charles Sizemore. Until next time, everyone, safe trading.